Hello and welcome to TNM TV News. I'm Anthony Vaccaro, staff writer with the Northern Miner. This week we bring you an interview with Danielle Park, a portfolio manager and co-founder of Venable Park Investments. Mining Markets editor Alicia Hyatt spoke with Danielle at the recent Cambridge House conference in Toronto. Danielle shed some light on how the current secular bear market in equities is affecting the secular bull market in commodities and what she thinks is in store for markets. She also questions gold's safe haven status.
Danielle, you're a little bit of an anomaly at these shows. Everyone else is talking about commodities and resource stocks, and you're talking about the market in general and the bigger cycles. How did you come to be a speaker at the Cambridge shows?
Well, it's interesting. Joe Martin, the founder of Cambridge House, saw an article about me, I think, in the Financial Post in 2007 when my book, Juggling Dynamite, had come out. And it gave me a very bearish title on the article in question because at that time I was warning about the credit crisis and how it would affect, asset prices and the risks to investors. So he was kind of attracted to that. The resource base often has a sort of bearish bent in the gold crowd, etc., and just asked me to come speak. Actually, it was at this Toronto show, I think the first time in 2007. And then I just joined the circuit after that and sort of have attended every one of their shows in various parts of the North America since then.
And how do resource investors take to your message?
Well, I think, in 2007, people were very much in love with the idea of a secular bull in commodities. And I was acknowledging that, indeed, we were in the midst of a secular bull in commodities. But layered over that has to be some awareness of how correlated financial markets have become. So back in the last great secular bull in commodities, the 66 to 82 period, you did have a general trend up in demand for commodities and prices over that lengthy period, that secular cycle. But in the interim, you had a lot of violent swings with the business cycle. And so I'm trying to teach people that just because you're in a secular bear in a particular area doesn't mean that, financial market volatility, for example, will not be a huge influence on price movements within that secular period. So you get a lot of volatility. You get copper, dropping by huge amounts still within this, quote, secular uptrend. And I think that's where my proficiency is really about managing risk to capital and pointing out that nothing moves in a straight line, and that if you're sort of banking on being this complete mountain that you're climbing and you're not taking account for massive valleys that come in the interim, that can be very devastating. Psychologically, it can be very hard on businesses who are trying to develop, an actual mining company, for example, who is trying to get access to capital, and then they get the credit crisis overlaid on that, which impacts liquidity and appetite for risk repeatedly through this period. So I think that it's very important for people, whether they're trying to manage a business in this sector, whether they're trying to invest in this sector, that they're careful about buying and selling within this period, or they're going to be sort of taken unawares.
So you say we're in a secular bear right now. Where are we in that cycle?
Well, the secular bear that we've been in since 2000 has been in equities. So equities started this last 12-year period highly overvalued, the highest valuations ever in history. And history tells us that each time you come into that period, it has to work that excess off over a period of 15 to 20 years typically. As the business cycle, each time it comes, the recession hits, stocks make a fresh low or come back to retest, and how over time they eventually become undervalued. So we are 12 years into this particular secular bear cycle. Yes, there's cyclical opportunities for buying within that. We got one in 2002, 2003 was a buying opportunity cyclically within this long downtrend. And then you got another one in 2009. But now, because it was so far so fast, so much on government interjection and trying to prop up asset prices as opposed to letting the business cycle do its normal clearing that needs to happen, now you're back to a high risk scenario again, within 2 years of the last one. So that's kind of frustrating for people because they would love to just, look for good companies, look for good management, buy on an investment thesis and not think about, worrying about interim shocks to the system. That's just not the environment we're in today, unfortunately. So you have to be prepared. And liquidity crunch hits, people sell the things they love along with the things they don't. And that can hit some of the, especially junior mining companies where, they tend to be the more volatile or the more risk capital. It can sell off dramatically when you get a liquidity crunch.
So are we near the end of the secular bear?
In the stock market? We are definitely moving along. We're definitely perhaps 3/4 of the way through, I hope. I hope we're not just halfway through. You know, one of the things we've learned from Japan is that the more governments try to intervene to prop up assets, the more they give QEs and this sort of a thing, the more extended that downturn becomes. So where if you allow the recession to clear out the bad businesses and bad asset prices and reset the system, you get into the growth phase, a real sustained growth phase faster. So it's still uncertain to what extent there's continued appetite here for more intervention. It's possible that you will see less of that going forward, in which case asset prices will correct as they've started to do since April of this year. I think we're in the next cyclical downturn within this ongoing cycle, and that we could see a recession again in the very near future, in which case the stock market will probably sell off another 20 or 30% in that kind of environment, potentially. And commodities, which have traded almost lockstep with equities since the '09 low, they trade much more like financial assets than hard assets, I'm afraid. And that means that if stocks drop a lot, commodity prices probably will as well. And there'll be another important buying opportunity. But you need to get there first. You need to not lose on the correction phase. And you need to have liquidity so you can buy when those prices present.
So investors have flocked to gold as a safe haven in this environment, but you don't think the prices are sustainable. Why not?
Well, I don't get the investment thesis of it. There isn't really an investment thesis. It's not really you buy this and people will want to use it for this purpose, or it doesn't pay you income while you hold it. It's an aversion to the U.S. dollar, to governments, to fiat currency. Understand all that. The problem is that, as we saw in the last cyclical downturn, when people need cash, they raise it from all the sectors. They tend to sell paper assets across the board. So that could include, as it did the last time, gold companies, gold ETFs, gold indices, gold shares. So you don't normally get a lot of safe haven aspect to those particular paper versions in the kind of crisis or downturns that we've been seeing in the last few years. In which case you could see a sell-off in some of the things that people are convinced are, the safest haven. It doesn't mean they can't also decline in value during that climate.
Thanks for watching, and join us next time for an interview with newsletter writer Mickey Fulp.